Welcome back to another episode of the Aparti Fi Podcast. I'm your host, Roderick Jones, and I'm excited that you are joining me here on another episode. On today's episode, we're talking about the current state of the multifamily market. Hey, multifamily investors, welcome back to the podcast. Today, we're setting the stage for the year ahead by diving into the current state of the multifamily market. We'll explore the exciting opportunities, navigate the looming challenges, and arm you with insights to make informed investment decisions. So let's get right into it. So the multifamily market overview. I got good news and I got bad news. Which one do you want to hear first? Good news? Okay, we'll go there. So the good news is, if you see me looking down, so before we get into the good news, if you see me looking down, just know I am not that good, and I am looking at my notes that I have here I've prepared for this podcast. So the good news is that multifamily remains resilient. It remains one of the most resilient asset classes compared to office and retail and all the other hospitality, all the other asset classes. Multifamily remains a resilient, strong asset class with strong fundamentals. Now, the reason I say this is because rent growth continues to outpace inflation. That's a good thing. Occupancy rates are holding steady. In some markets, you have occupancy that is way down, but for the most part, they're hovering around 90 to 95%. And the demand for quality apartments is still strong, and it doesn't look like growth is slowing down anytime soon. So those are the good things. Now let's get into the next list of great things. So what are the growth factors? What are the things that's driving the growth for the multifamily market overall? So I tell you, we have three things. We have demographics. We're going to look into three things. We're going to look into the demographic trends. We're going to look into job market, and we're going to look into the supply. So let's go to number one, demographic trends. So the reason we say that this is one of the demographic trends or one of the growth factors is because millennials and Gen Z is entering into their prime earning years and their prime renting years. And so what this means is you have a new wave of clientele that is, coming in to rent instead of buy. And so this new wave of clientele is looking for certain amenities and certain things within their community that the older clientele wasn't. So you have a changing of the guard almost, meaning that the older generation is moving out, such as moving out and moving on. Maybe they're buying houses. Maybe they're moving into the senior living communities like the 55 plus apartment buildings. Maybe they're moving into something like that. And then you have this next wave of millennials and Gen Z who are looking to rent in the market today. Now, what millennials and Gen Zs are looking for is totally different than what the past generation was looking for. So the reason this metric is important is because you can take this and say, okay, when I'm doing my value add play, I know that I need certain amenities. I know that I need to work from home space, or I know that I need a common area where people can work from home, go to the common area. It's certain things that you need to put in place to attract a certain type of renter. And now that millennials and Gen Zs are the next prime renters, you need to adjust your strategy accordingly, and you need to make sure that you're accommodating the next generation of renters. So let's move over to growth factor number two. So with growth factor number two, we're looking at job market expansion. So the job market in the U.S. has been robust, meaning that, jobs have been growing. And in the top two markets that I'm looking at is tech and healthcare has been expanding aggressively. Now, of course, we have layoffs at the big tech firms, and we have layoffs at the financial firms and healthcare firms. But job growth continues to remain strong, and it continues to keep growing, even though some companies have been trimming the fat. Now, we'll get into the job market in the next one. We'll dive deeper into the job market and some of the challenges in the next segment. So That's that. And as we know, the growth, one of the metrics that we look for when determining a multifamily market is job growth. So that's the reason this whole thing even made the list. Job growth is one of the top factors that we're looking at. And when you're picking your market, you're looking at job growth to make sure job growth is there, because job because job growth drives population growth. And so overall, job growth in the US has been strong. It looks like it's going to continue to remain strong. But then again, who knows? Don't really have a crystal ball. So that's that. Let's move over to the third one. Limited supply. So construction costs and regulation hurdles. So construction costs and new regulation hurdles have kept new apartment construction at a constraint. So this is a good thing and a bad thing. So it takes about a year or 2 years for new apartments to develop. And if apartments were being developed in 2022 and now we're in 2024, we're going to see a lot of those units coming online this year. But if new apartments aren't being developed, that means there's going to be a lot more demand for the units that is coming online, which is also a great thing for the multifamily market, because as you know, when buyers want to buy and there's only limited supply, this allows for the prices to go up. Now, we talked about the three growth factors. The three growth factors were millennials and Gen Zs are now in their prime rental years. Job growth and population growth. Job growth has remained steady and it seems to continue growing. And then construction costs and new housing regulations has constricted the new development or the new development deals that are coming to market. So that's the growth factors or the growth drivers. Now, we can't talk about growth without challenges. And remember when I told you when we first came into this podcast episode, I have good news and I have bad news. And the bad news is the challenges. So what are some of the challenges that we're going to face in this current market? And so I would like to say this: despite the optimism, we need to acknowledge the challenges. And so rising interest rates is going to be one of the challenges. Now, I know that the Fed is supposed to decrease rates, which also brings up some concern, but I know that the Feds are supposed to decrease rates. When the Fed decrease rates, that means that there should be a lower cost of capital, which means that more buyers should have access to capital, which means that more people are going to borrow so that way they can do deals. Now, this is a double-edged sword because, yes, the Fed may decrease the rates, but in order for lenders to feel safe and secure at lending, they may still lend at higher or inflated interest rates to make sure that they can weather any downstorm and make sure that they're decreasing their capital risk or decreasing their exposure to multifamily deals. Because as we know, when money is cheaper, people tend to make irrational decisions or irrational investment decisions and go and get the max leverage. And then once everything hits the fan, the lenders have to take the deal back. And so the reason I say rising interest rates is a concern is because even though the Fed is going to decrease interest rates, we still may see some banks and some lenders still lend out at higher interest rates just to protect the downside risk. So rising interest rates is one. You'll probably hear a lot of people saying interest rates are coming down, but it just depends on how much leverage you use and how much risk the lender is willing to take on. All right, so affordability. So this is another concern. Affordability remains another concern because if you as a multifamily investor is buying multifamily real estate at a premium price, that means that you're going to have to increase rents. And if rents are already high, that means that you're going to drive them even higher. And if you're driving them even higher and people can't even afford them now, that means that you're buying a deal and trying to drive the market higher and higher and higher. And maybe your clientele can't afford what you're looking to what you're looking to do as far as your value add strategy. And so as we can see in some markets, affordability is becoming a major issue, and maybe it's already been affordability is becoming a major issue. And in some markets, affordability has already been a major issue. And with the rent increases coupled with inflation, that might price out some segments of the market and some segments of the renter population. And so you don't want to price yourself out of the market. You want to make sure that you're still within that sweet spot of how much people can afford. And if you're finding yourself drifting towards the top of it, make sure you implementing your value add strategy, how you're going to accommodate those renters who really can't afford your units. And if you say, I'm buying deals and I'm only targeting the top people who can afford it, blah, 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 let those people lose their jobs and see what happens. Then you're going to have to readjust your valuation strategy, your value add strategy, decrease rents in order to fill it up. So that's the reason why we say affordability is a concern, and it's one of the challenges that's on the market. So when you're buying your deals, make sure that you underwrite it for the best case scenario and you underwrite it for the worst case scenario, and try to make both scenarios work. So let's move over to the third one. This is a big one. This is a big concern for the multifamily market. Geopolitical uncertainty. It's an election year. Who's going to win the election? Is it going to be Republican? Is it going to be Democrat? Is it going to be this? Is it going to be that? And this ultimately determines how housing policies are shaped going forward. This ultimately determines, if rates are going to increase, if they're going to decrease. This ultimately, it's a lot of uncertainty. And when you have a lot of uncertainty, that means you have a lot of volatility in the market. And so determining on who wins, who loses, all of that creates uncertainty. And this ultimately puts a lot of market risk and political risk at hand when you're buying multifamily deals. And so in order to combat this, we're going to go into how to combat it next. So that's that geopolitical uncertainty. We don't know who's going to win an election. We don't know if Republicans are going to win, if Democrats are going to win, if independents are going to win. It's just a lot of uncertainty there. So that is another big challenge in the market. And then the last challenge that I want to bring up is the buyer and seller delta. And so what I mean by this is sellers still want to sell for yesterday's prices and buyers want to buy for today's prices. And the delta has been huge in the past. So in the past year, sellers may want to sell for $1 million or $3 million more than the buyer can afford to buy at, and buyers want to buy for $3 million less than what the seller can afford to sell it at. And so that is a big thing or a big challenge that's going on in the market today. And a lot of people think it's going to be doom and gloom with these people who have their bridge loans coming due and all of that. That may happen, that may not happen, but that's another challenge that's going on in the marketplace today. All right. So navigating the landscape. So what can you do? What does all this mean for you? What can you do to make sure that you are optimizing your deals, making sure that you are prepared for anything that may go wrong and, everything like that. So one thing I want you to know is that don't be discouraged. The market is cyclical, and the best thing for you to do is to be prepared. So how do you be prepared? This is what you're going to do. So number one, you're going to focus on value add strategies. And so when I'm saying value add, that means you're focusing on opportunities where you can come in and increase the value by either leasing it up, increasing rents, making it look better, certain things like that. Ultimately, what you're trying to do is increase the NOI. Solid value add play that you could do is just a lease up strategy, meaning that a majority of the properties is already under market lease. The only thing you're doing is coming in and leasing those properties up to get them to market lease. Get them to market rate on their lease. So value add, focus on value add strategies. Next, you want to prioritize strong locations. So this is where market fundamentals really come into play. And when I say they come into play, it means that you're focusing on markets with job growth. You're focusing on markets with strong population growth. When you're in the markets with job growth and strong population growth, you're focused on assets that is in a strong location, meaning that it's in an economic hub or it has visual appearance to drive traffic to increase your visibility for renters. It's a lot of things that goes into that, but you want to prioritize strong locations. So maybe primary markets, secondary markets, some tertiary markets, but primary and secondary is probably what you want to do. But then it also there's a flip side to this. If you focus on primary and tertiary markets, then some people are saying, primary and secondary markets, some people are saying everybody's focusing on primary and secondary. We're going to go over here and focus on tertiary. And then that's a strategy that that's going to allow us to, hit our investment returns. So it's a plus and minus to both strategies, but focus on strong locations. Let's move over to number 3. Number 3 is secure flexible financing. And so when I say secure flexible financing, I'm talking about consider alternative financing such as preferred equity or inputting some mezzanine financing in your deals, or looking for joint venture capital or joint venture equity instead of just common equity where you're paying your LPs just their straight pref. So look at some flexible ways on how to structure the capital stack to de-risk it or to minimize as much risk as possible, and to figure out, if things go wrong, how can I make sure that my backing is secured enough to ride the wave with us? So that's that. And then lastly, build a diversified portfolio. Make sure you spread your portfolio out across certain markets. Now, most people would say that is a horrible idea. You need to focus on one market and you need to get really good at that market. That's cool. But what you can also consider doing is focus on 3 markets and spread it out across those 3 markets. So that way, if one market goes down, you still have 2 other markets in your portfolio that is doing well. And if 2 markets go down, you still have the 3rd market in your portfolio that's doing really well. So maybe you should consider spreading it out across multiple markets. So let's recap this. What can you do in this current environment to make sure that you are preparing yourself to have the best 2024 for multifamily, your best multifamily 2024 year? So basically, you want to focus on value add strategies. You want to prioritize strong locations. You want to secure flexible financing, such as joint ventures, preferred equity, mezzanine financing. And you want to build a diverse portfolio. Spread it across maybe 3 or 4 markets. And if one market doesn't do well, at least you have 3 other markets. Last thing that I want to say is the multifamily market is dynamic. So all of this can change at the drop of a dime. So what I want you to do is stay informed, stay on the edge of your seat, stay looking and learning emerging trends and watching and just updating yourself and learning every single day, because everything changes and everything can be significant or it can be not as significant. Policy changes can happen and policy changes may not happen, but you just need to be adaptable. Make sure you adjust your strategies and make sure you have some flexibility in your plan. So that is it for today's episode. Make sure you leave a like, make sure you share, and make sure you subscribe to the show. And if you got anything from the show, if it made you think, if it made you laugh, if it made you cry, share it with somebody. Tell them you listen to the Aparti Fi Podcast with Roderick Jones.